Welcome to part 5 of the 8-part lecture series on the coming 2026 financial and economic crisis. Just when it seemed that interest in the single tax idea was gaining public support, world events intervened. There was no time for the debates while fighting the First World War, yet there were enough supporters still around in 1919 for the establishment of a new national single tax party, running candidates in many elections across the United States. Interest in what single taxers called for found less and less interest as the 1920s advanced. So single taxers tried a new strategy by renaming themselves the Commonwealth Land Party in 1924. Candidates were put forward for president and vice president in 1924 and again in 1928. And there was even less opportunity for meaningful debate while governments dealt with the problems of the Great Depression, including crashing land values. Government now had no choice but to embrace intervention. The Keynesian revolution took hold from the late 1930s on. Those 20th century economists who agreed with Henry George found themselves isolated within their discipline. As explained by University of California professor of economics Mason Gaffney in 1994, few people realize to what degree the founders of neoclassical economics changed the discipline for the express purpose of deflecting Henry George and frustrating future students seeking to follow his arguments. The strategy was semantic, to destroy the very words in which he expressed himself. By the mid-1930s, the arguments for allowing an economy to cleanse itself of the excesses that brought on economic contractions were losing out to a general acceptance that government has a moral obligation to do what it can to lessen the depth and shorten the duration of a major depression. Keynes suggested in 1926 that the end of laissez-faire was at hand. He wrote, "Economists, like other scientists, have chosen the hypothesis from which they set out and which they offer to beginners because it is the simplest and not because it is the nearest to the facts. Partly for this reason, but partly, I admit, because they have been biased by the traditions of the subject, they have begun by assuming a state of affairs where the ideal distribution of productive resources can be brought about through individuals acting independently by the method of trial and error in such a way that those individuals who move in the right direction will destroy by competition those who move in the wrong direction. This implies that there must be no mercy or protection for those who embark their capital or their labor in the wrong direction. It is a method of bringing the most successful profit makers to the top by a ruthless struggle for survival, which selects the most efficient by the bankruptcy of the less efficient." Keynes eventually came to the observation that describes the extent to which attitudes were to change as the world's leaders came to grips with the prospect of global warfare. War experience in the organization of socialized production has left some near observers optimistically anxious to repeat it in peace conditions. There was no going back. The end of laissez-faire that occurred in the early 1930s was not merely economic but political. As this photograph ought to warn those of us who believe in the promise of democracy, who knows what might have occurred in the United States if the Roosevelt administration had not responded as it did. The systemic threats to democracy are as or more serious today than they were during the 1930s. By 1936, officials at the Federal Reserve and the U.S. Treasury began to fear a renewed expansion of credit by the banks. The Fed doubled reserve requirement ratios. Then the Treasury decided to sterilize gold inflows, which severed the link between gold inflows and monetary expansion. The monetary expansion was abruptly halted, At the same time, the new Social Security payroll tax was introduced along with a tax increase mandated by the Revenue Act of 1935. A recession was triggered. The recession ended in 1938 after the Fed rolled back reserve requirements, the Treasury stopped sterilizing gold inflows, and the Roosevelt administration returned to expansionary fiscal spending. Importantly, orders for armaments from Britain and France reopened factories and brought idle workers back into the economy. In May of 1940, Mariner Eccles, chairman of the Federal Reserve Board of Governors, addressed members of the Economic Club of New York on the continuing challenges of getting to full employment and what he thought was the proper role of the federal government. We talk about the paradox of want in the midst of plenty, but the real paradox is that with all our boasted native genius, we do not end the dilemma. I think it is clear that the proper role of government is to be an umpire, acting in the interest of the general welfare, not taking sides for or against the numberless conflicting private interests. As his address continued, Eccles eased into the argument for the kind of intervention Keynes believed to be necessary to soften the consequences of the economic cycle. The ideal of a free economy which will automatically adjust itself is an admirable textbook dream, but it is not the real world in which we have to live. The difficulty, as I see it, arises from the way in which the national income is currently distributed. Too much idle money is piling up in the banks unused by individuals, corporations, and other institutions owning the funds. Too little is going into the hands of potential consumers. Remember that this address was delivered in 1940. Eccles then offered advice to the nation that is again coming from Stephanie Kelton and others within the MMT community. Then why shouldn't we declare as a national policy that we will collectively, through government, offer the security of a job to all who are willing to work but are unable to find private employment? Why not provide assurance of employment, not merely insurance for unemployment? Is this a radical idea in a democracy? Is it in any way inconsistent with our professed ideals and aspirations? Is there any better way to make democracy work? Can't we afford it? I have not found anything written in response to the views expressed here by Mariner Eccles. I am sure there were responses, if only privately expressed. To many, what he proposed opened the door to a far greater expansion of federal intervention in the economy than most of those in possession of enormous wealth would entertain, then or today. Already by 1940, as shown on this map, Americans were moving in search of a better life. Many new centers of manufacturing were opening to meet the demands of the military. And even then, some thought had to be given to how the economy would adjust to the challenges of the decades to come. The bottom of the last economic cycle might be behind the nation. Could they begin to so manage the economy so that the new cycle would not become overheated and bring on yet another financial and economic crisis? But as the year 1941 ended, the nation was pulled into the Second World War. And once the war production infrastructure was established, there was little thought given to how much was enough. The U.S. military force increased from around 345,000 to over 6 million by the end of the Second World War. In 1939, the U.S. had about 2,500 airplanes and 760 warships. By 1945, it had about 80,000 airplanes and 2,500 warships. By the time U.S. forces landed on the shores of France, some economists began to discuss what might happen once the war ended and the U.S. demobilized. By 1943, More than 2 million women were working in American war industries. The war production effort brought immense changes to American life. As millions of men and women entered the service and production boomed, unemployment almost disappeared. The need for soldiers enabled black Americans to secure reforms that integrated the military and set a precedent for post-war civil rights activism. By the war's end, blacks made up 8% of the defense industry's workforce. Black employment by the federal government increased by 300%. In hindsight, one could argue that some of these resources, even during the war years, could have been channeled to solve serious physical and social infrastructure problems, such as the air and water pollution that plagued the populations of industrial cities such as Pittsburgh. These are photographs of the city of Pittsburgh in 1940 during the noon hour. Throughout the war, economists came to have greater and greater influence over legislation and economic policy. Thanks to the efforts of Mariner Eccles and economists such as Alvin Hansen, Keynesian demand management theory was embraced after 1945 to fine-tune the economy for what was hoped would be stable economic growth. Hansen, who joined the faculty of Harvard University in 1937, provided his economic thinking in the 1938 book Full Recovery or Stagnation. He argued that stagnating employment levels would continue for decades without governmental intervention. Further, Hansen asserted that controlling inflation required timely changes in tax rates, expansions or contractions of the money supply, and effective wage price controls. On the 25th of November 1947, Mariner Eccles appeared before the Joint Committee on the Economic Report in a special session of the U.S. Congress to discuss how the Federal Reserve was responding to post-war inflationary pressures. I extract just one brief comment he made that captures quite succinctly the wisdom of the time. At best, monetary and credit policy can have only a supplemental influence in any effective treatment of either inflation or deflation. In considering what can be done so far as monetary and credit action is concerned, it is necessary to make a correct diagnosis of the multiple causes of the situation with which we are now confronted. In his testimony, he notes that many people were, quote, being priced out of the market for housing, unquote, but does not connect this with rising land prices. However, he does call for new authority to restrict the expansion of bank credit, adding, the need for this authority would be less if Congress authorized other anti-inflationary measures such as restoration of consumer installment credit restrictions and if stricter appraisals and less liberal credit terms were applied under the Veterans Administration, the FHA, and the Home Loan Bank programs of housing finance. Had he a better grasp of the dynamics of land markets, Eccles might have embraced a specific tightening of bank lending to prohibit any financial institution that accepts government-insured deposits from extending credit for the purchase of land or the acceptance of land value as collateral for borrowing. This would have protected the bankers from land market risk and the taxpayers from imprudent bank lending. More recently, University of California professor of economics Mason Gaffney supported this change in bank regulation, writing, one might hope that banks and other financial intermediaries would show restraint and prudence by refusing to lend against overvalued property during the period of rising land prices. That is not usually what happens. Bankers fuel the frenzy by overlending to land buyers and refinancers with inflated appraisals. Mason Gaffney knew something about how the players in the game of real estate manage to bend or sidestep institutional or governmental rules to get deals done. Putting pressure on real estate appraisers to support an agreed-upon sales price is just one of the tactics utilized by commissioned salespersons. What Mason Gaffney understood better than most was that investing in real estate near the top of an economic cycle carries considerable risk. When the price of land eventually stops rising and buyers default, many financial intermediaries are criticized for being corrupt and/or mismanaged. While that may be true, attributing the negative results solely to bankers distracts us from the larger pattern that causes crises. What Mariner Eccles, Alvin Hansen, and most other Keynesian economists missed in their analysis was the fact that the cost of land returned to an upward climb as early as the mid-1930s and continued to increase during the Second World War. Farmers were encouraged to add acreage and were provided with financial assistance and other subsidies. People were on the move, coming into the nation's industrial cities to work in the wartime factories. The demand side of the nation's land markets worked its magic to the benefit of the nation's landowners and speculators. The price of residential property rebounded, as one would expect, and incomes increased. Wartime restrictions and a shortage of both labor and materials significantly lowered the number of new housing units becoming available. The shortages were particularly sharp in those regions experiencing in-migration. Between 1940 and 1944, housing starts declined to just 141,000. Setting the stage for a post-war boom, the 1944 GI Bill of Rights created a program that provided federally insured loans to veterans, and millions of young adults immediately began to form new families. Still affordable land near cities, mass construction techniques, very low mortgage interest rates, and government guarantees changed the landscape surrounding the nation's major employment centers. It took a few years to get going, but during the decade ending in 1949, just under 5 million new homes were constructed. That number doubled during the decade ending 1959. Many, mostly exclusively whites, began moving into the newly constructed homes in suburban communities linked to urban employment centers by highways and public transit systems. This is a 1959 photograph of the Schuylkill Expressway connecting Philadelphia with the Pennsylvania Turnpike near Valley Forge. Construction began in 1950 and opened on the 25th of November 1958. The cost to construct was $100 million. In today's dollars, roughly $1 billion. Similar connecting highways were under construction all across the nation. The need for such new highways was created by tax benefits that favored the development of single-family suburban subdivisions. For example, payments of mortgage interest and local property taxes were deductible from an individual's income before calculating the federal income tax. Suburban subdivisions offered open space and a different lifestyle. By 1950, the number of new housing units constructed that year reached 1,692,000. It is also worth noting that full employment during the Second World War provided the banks and the housing sector with a huge pool of savings available to start the new boom in housing construction. For most families, although new houses were relatively expensive, land outside the cities was still cheap. And as noted earlier, construction companies adopted techniques of mass production that made it possible to complete large numbers of homes in a short period of time and bring down the cost. New highways brought suburban land within reach of urban factories and jobs. The new bedroom communities were then quickly served by new public schools, libraries, hospitals, banks, and by shopping centers. All across the nation, the service sector was gaining in employment at the expense of manufacturing. Today, 3 out of 4 employed persons work in the service sector. The annual tax imposed on residential property and other real estate provided a stable tax base for the new suburban communities. Gradually, inevitably, demand and speculation combined to drive up land prices and push development further and further into what had been rural regions. And so rural populations continued to decline. In the mid-1930s, there were still 6 million farms in the United States. In 2012, there were only 2 million. Average farm size has essentially doubled. The top 10% of farms in terms of size account for more than 70% of cropland. A third of all cropland is run by 2.2% of all farms. The side effects are that just since 1950, the percentage of Americans living in urban areas increased from 64% to 83%. Larger farms and enhanced mechanization has allowed the United States to become a major net exporter of agricultural products. Economists remembering history argued as the Second World War was ending that measures were needed to prevent a repeat of the problems that occurred after the end of the First World War, when commodity prices fell dramatically and farmers could not service debt. Now somewhat protected against runs by anxious depositors, banks provided financing on favorable terms to farmers, and the result was an almost steady surge in output as well as agricultural land prices as the increasing U.S. and world population stimulated demand for what farmers produced. The picture is complicated, to be sure. Stagflation, beginning in the late 1970s, brought on a rural financial crisis that finally burst in 1985. All around the globe, land was being irrigated, fertilized, and brought into production. Investors, as well as actual farmers, had taken advantage of high crop prices between 1970 and 1985 to expand acreage, and land prices had quadrupled as a result. What happened in 1985 was a rude awakening for those farmers who were still highly leveraged. As earlier explained, the first strong effort to tame the inflation of the 1970s occurred when Paul Volcker, chair of the Federal Reserve, engineered the first of two brief recessions. Volcker set interest rates on an upward climb beginning in late 1979, raising the Fed's interest rate to 13.7%. Months later, it reached over 17%, and during 1981, neared 20% several times. At those rates of interest, the demand for credit slowed considerably. Prices of goods and services began to come down as overall demand fell. Economists declared the nation in the first brief recession as early as January 1980. Interest rates were lowered and inflation reignited. So the second tightening occurred as the second recession occurred in July of 1981. Official unemployment reached and passed 10% in December of 1982. During this same stretch, the agricultural sector was hit hard by declining commodity prices. Record production resulted in a glut of farm commodities, forcing prices down. This glut, combined with a U.S. export decline of more than 20% between 1981 and 1983, following the 1979 Soviet Union embargo, caused farm debt to hit a staggering $215 billion by 1984, double of what it had been in 1978. Agricultural land values fell by up to 60% in some parts of the Midwest from 1981 to 1985, and farmer bankruptcies surged. In just 1 year, 1985, 62 agricultural banks failed. Over 250,000 farms were lost to foreclosure sales during the decade. The loss of farms owned by black farmers was 5 times the average. Investigations of prejudice at the U.S. Department of Agriculture resulted in a $2 billion award to affected farmers in 1999. $1.2 billion delayed until finally appropriated by Congress at the end of 2010. Very few of these farmers recovered their farms. However, procedural changes adopted at USDA have resulted in a 9% increase in the number of farms owned by African Americans. The number of Native American farm operators has increased by 88%, and Hispanic farm operators have increased by 14%. In each case, the number of women farmers within these groups has increased significantly. The average size of these minority-owned and operated farms is about 140 acres. Farm incomes recovered slowly from the mid-1980s lows. Importantly, total agricultural debt dropped by 30% from 1984 to 1990 as lenders wrote off bad loans and other farmers paid down debt. Land prices stabilized and then began to rise. By 1992, unadjusted for inflation, they roughly had regained their 1984 levels.